Budget Part 3. Budgeted income statement. Okay, if we complete the cash budget, we will go to the budgeted income statement. Okay, for example, Royal Company budgeted income statement for the 3 months ended 30th June. So this is the example of the budgeted income statement. We have sales, cost of goods sold, and we have the gross margin. And then selling and admin expenses. Okay, we get the operating income, and then we less with the interest expense. So we get the net income. So this is example of the budgeted income statement. So Royal reported the following accounts balances prior to preparing its budgeted financial statement. So this is the information: land, common stock, retained earnings, equipment. So from that, we'll produce the budgeted balance sheets of Royal Company as at 30th June. So this is the uh, budgeted balance sheets look like. So objective 4, flexible budget. So what does it mean by flexible budget? Static budgets and performance reports. Static budgets are prepared for a single or planned level of activity. Performance evaluation is difficult when actual activity differs from planned level of activity. Alright. So take a look at the flexible budget. May be prepared for any activity level in the relevant range. Show costs that should have been incurred at the actual level of activity, enabling apples to apple comparison. Review variances related to cost control, improve performance evaluation. So we take a look at the example. Okay, for static budget. Okay, for under 10,000 machine hours. Okay, and the variable cost, fixed cost, the total overhead cost is 89,000. Okay. But the actual results, okay, the company only managed um, to operate in 8,000 machine hours. They are budgeted for 10,000, but actual results, the company only managed to operate at 8,000 machine hours, and as a result, this is the cost incurred. So from this, actually, if we take a look at the variance, okay, we got several variances, unfavorable and several favorable variances. Okay, but if you take a look at, we are actually compared to different levels of activities. So this is not really um, correct. Okay, so I don't think I can answer the question using static budget. Actual activity is below budgeted activity. So shouldn't variable cost be lower if actual activity is lower? So just now, actually, we have already seen, okay, that we budgeted 10,000, but the actual operation is 8,000. So we actually cannot really compare it. The relevant question is how much of the favorable cost variance is due to lower activity and how much is due to good cost control. To answer the question, we must flex the budget to the actual level of activity. To flag a budget, we need to know that total variable costs change in direct proportion to the changes in activity. So as the activity change, the variable cost will change in direct proportion. Total fixed costs remain unchanged within the relevant range. So let's prepare for flexible budget. Okay, so machine hours, okay, variable cost, total variable cost, fixed cost, and then we will at the end have the total overhead cost. So under flexible budget, we do on certain activities 8,000, 10,000, and 12,000. Okay. So under 8,000 hours, okay, we get all those figures inserted and we get the total variable cost of 60,000, and at the end we get the total overhead cost of 74,000. So under 10,000, okay, and under 12,000, right? So preparing a performance, okay, okay, we are written back, okay, on that particular budgets. Okay, for flexible budgets, we have several activities. So if the actual operation occurs at 8,000, so we can compare the planned budget with the actual budget of 8,000. And if the actual budget is 10,000, and we can compare with the planned budgets here. So it is more orange to orange. Objective 5, preparing a performance report. Okay, so let's prepare a flexible budget performance report for the cheese company. Okay, so flexible budget is prepared for the same level activity, 8,000 hours as actually achieved. Okay, for 8,000, the flexible budget, okay, so we get the variances for indirect labor, unfavorable, in indirect labor, unfavorable, for power, favorable, and for insurance, unfavorable, and the total fixed cost is unfavorable. Okay, so actually we are comparing at the same level. Okay. So remember the question, how much of the total variances is due to lower activity and how much is due to the cost control. So if we are preparing the actual budget, actually we are comparing apple to apple at the same level. So we'll know that if the variance occur, does it because of the lower of activity or because of lack of control by the manager. Okay. So this is the difference between original static budget and actual overheads. Okay, so we will know that the differences between static and flexible apple to orange is because of the activity level is different, and orange to orange is because of the cost control. Because the activity level is the same, so it is the deviance or the variable is because of cost of control. Either is good or uh, bad cost control by the manager. So this is the end for chapter 2. Thank you very much.